Welcome to Be the Market Expert. And let's kick it off with this thing. So this is from Housing Wire. This is what yesterday. It says home builders sales incentives are in full bloom this spring. It says home buyers are not the only ones getting incentives, and analysts report builders are still offering buyer agent bonuses despite the NAR settlement. Okay, cool. So I don't want to dive into that too much, but yeah, this is what we have seen. We've been seeing a lot of different surveys and articles popping up that even with the NAR settlement that has gone through, that there has not been a huge disruption to compensation to agents. And I think if anything, what that proves is a couple of things. Firstly, that your services as a real estate agent are valued first and foremost. They're valued. And the second thing is going through and providing this value is in a world where most people don't understand what is truly happening through this progression of their contract, through the sales, through all these different things. And like you are the real estate economist of choice, and people are willing to pay it. Now, what we're also seeing is that the people that are actually purchasing homes, they do have the ability to go out and purchase right now, right? When we think about the landscape of the real estate industry right now, money's expensive, right? Money's expensive. We understand this when we're looking at interest rates being what they are, and the dollar amount for a home when we're talking about this over the course of 30 years, every month, here's your payment. This is not an Amazon purchase. So that wasn't necessarily the point of this article, but I did want to look at this. It says incentives. All right, so let's look at this. So it goes through and it says, the spring home buying season's in full spring, but what we typically see is the busiest time of year for home builders hasn't lived up to the hype so far. Okay, cool. So we go forward a little bit further and it says, okay, builder confidence. So we're looking at builder confidence and they're saying like, hey, our sales are kind of declining right now. So builder confidence is going to go down. So we go through and we look at this thing, and this is the survey. And the survey says 34% of builders in May reported that they're cutting home prices, and 61% report that they are giving sales incentives. All right. So I look at this, and this is what I think about. Firstly, builders are not the March of Dimes. They are for-profit companies that answer to shareholders. That's the big thing that we need to look at. Now, when we're going through and we're thinking about this, we also have to keep in mind what happened back in 2008. So it says in 2008 and early 2009, 44% to 72% of builders surveyed reported using tactics like free or reduced cost upgrades, closing cost credits, and homebuyer price reductions to help them offload inventory during the Great Recession. So let's fast forward a little bit further. So if we look at this thing and we're talking about this, it says it right here. It says during the Great Recession, builders had 1.5 million unsold homes, where today they have 503,000. All right. So this is all very interesting, right? Because when I'm looking at this information, and we just started thinking about like what happened to the builders put a line in the sand, especially here in Colorado. Like think about what you see in Colorado. Yes, there are spec builders, and there are some major companies that are spec builders that have, it's a if we build it, they will come mentality. But yet, builders in Colorado, we don't typically see this. What we see, again, guys, and this sounds repetitive, but I think it's important as we're having these conversations because these are the conversations that are going to come up more and more and more. Yet when we look at this thing, what happens? You see the red balloon up in the sky, you go there, you walk into the sales office, they have that plat map, right? The lot and block. They got little red dots, little green dots on the community. And what happens? Your buyers get to go and they get to pick their plot of dirt. And the builder says, awesome. This will be your plot of dirt. Please give us X amount of dollars and we will start building. We will see you in 1 year from now. And that's what it looks like, guys. So as we're going through this and we understand that builders were like, no, 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 I'm not getting caught holding the bag again. There's 503,000 unbuilt homes right now versus where we were during the Great Recessions, where there was 3 times the amount. What we're seeing right now is we're seeing the Fed. We're in an issue right now in the sense to where the cost of money is just super expensive. All right. We're not seeing a lot of people lose their jobs. We're not seeing anything, right? We're seeing a lot of people still spend money. We're seeing credit card debt that is absolutely ridiculous right now. The American dream is not dead. What is happening though is the cost of living is going up. The cost of prices for goods and services is going up. The cost to borrow money is staying flat, but it's still pretty elevated, right? It's elevated. And so this is what's slowing people down. So what I think is going to be interesting as we go through and we look at this, these are the things that if I was back in production as a real estate agent, I would be looking to find out where are the builders? What incentives are they offering? And I would get on their email list. I would probably go through, I'd probably go take some shots of the neighborhoods. I'd be doing a social media campaign, getting this information out here. Hey, just toward this great area in Windsor, Westminster, Arvada, insert whatever here. They have some built homes right now where they are offering, 1%, 2%, savings on interest rates, right? And I'm just doing a big marketing campaign. Like I would just be pushing this out. I'd be making reels out of this. I'd be going through, I'd be doing stories. I would be pushing massive content so that I could actually take this and take so much mind share because guys, like they don't want to get caught holding the bag. They have the ability to do some pretty cool things where a traditional lender cannot do because the traditional lender is borrowing money where the builders aren't. They are their own bank. So as we're going through and we're looking at this thing, this is what we need to do. And we understand as well that, yeah, compensation for us looks pretty decent as well. But yet I would say this, the bigger thing is your clients can get a brand new home at lower rates than what they can with a bank. And you have the ability to go out and do this massive marketing campaign to get in front of them right now. And so this is what I would say, like, this is what I would do. I would go through and I would truly focus on this. Like, this is probably the big thing. And guess what? Like, as you're going through and you're looking at this, these homes are pretty, right? They're pretty homes. They're staged. You know that you're not going to go in and walk into a mess. And so you're going to go into these homes where they are going to encourage you to get them sold for them. They are not going to say these are our listings. Please don't take photos and do videos and everything. They want you to. And so I would be putting together a massive marketing campaign, knowing this stuff is happening. I would get on as many email lists as I possibly can. I would be creating reels, stories. I'd be putting these in my newsletters. I would be putting these up on my website. I would be doing everything that I possibly can to get this word out, to take so much mind share, because this, I think, is a little bit easier of a sale when you're looking at brand new, less interest rates versus the resale market at this current time. And again, this is also why we're not going to see anything massive drop. Like, what this also tells me is when we start thinking about price corrections, well, we have 1/3 less homes as far as new builds on the market. Our population has grown significantly in the United States of America. And so when we're looking at this is what points to like no massive price corrections for us. Like, there's still less homes. Yes, they're sitting on the market longer. There's still more inventory than we've seen since 2018, 2019, 2020, 21, 22, 23, 24. Yes, I totally get all of that. But yet the only reason why people are on the sideline is because the cost of money. It's not because they don't have jobs. It's not because of a recession that we're in. It's not because of any of this stuff. I mean, people are still buying, people are still on Amazon. People are still ramping up their credit cards. You know what I saw today, which was interesting? I got an email. I don't know if you guys got the same email, but I got an email from Costco. And so I got an email from Costco that says they're actually using Affirm now. And a firm is a company where you do payment plans. And I'm thinking like Costco is a company where you pay for a membership. Most people get a credit card with their membership, and people go in there and yes, they have impulse buys, but they're also going through and they are buying stuff like food and toilet paper and now alcohol and insert whatever else here. Like they're doing all this stuff, but now they're partnering with a company to where they can spread out their payments over months. And so it's not that people are pulling back spending. It's just that the cost of money is getting super expensive and they're maxing out other channels. And so like the American dream isn't dead. Let's just figure out different ways to get in front of the people to show them like what we can help them with. I want to go into this, speaking of, real estate. And so this is a newsletter that I'm a part of called Charted, CHARTD, I think is what it is. And so Sherwood is the company that kind of puts this stuff together, and it says real appeal. All right, cool. So I liked it because these are graphs around real estate. It says broadening the accessibility of luxury real estate is likely to hit home with Picasso's target market. Okay, so firstly, like we're looking at this thing, and there's a company called Picasso. And you guys could all Google it. And honestly, I would Google Picasso and go look at what they're doing. They're doing something actually pretty cool. I remember when I first saw their billboards a couple of years ago in Denver. And this company, what they're doing is they're going into these super luxury markets all over the world, from Breckenridge to Loom. Like they're going over and they are buying these multi-million-dollar properties, and they are putting together almost a timeshare, but where you actually own the property with somebody else. All right. So it's not like you're buying a week of time. Depending on how many owners there are, like you're buying like months of time. And yeah, I don't know the mechanics of it. Like, I don't know if it like turns or like that's your time that you buy. Like, I know none of that, but it's pretty neat. They're going out there buying these like $4 million properties, and then they're getting like 8 investors together, and you come up with $500,000, and now you're the part owner of a beachfront home in Tulum, Mexico, where you can either rent it out or you can take your family or insert whatever here, but it's worth looking at. Like I definitely recommend everyone go looking at that. But so that's this whole sale on this thing. But here's the infographic that came with it. And you can see like we got real estate up here, stocks, mutual funds, gold, CDs, and bonds, and then crypto, right, which came into play in 2022, which has taken a little bit of a dive. But if we look at this thing, it's saying since 2013, real estate has routinely beaten out stocks, mutual funds, gold, savings accounts when it comes to long-term investments. And it has taken a dip, and we can obviously see this. And this is because interest rates have gone up significantly. And so, like, as we're looking at this and we're kind of going through, and we talked about this, right? We talked about this team rally last week, where we were talking about there's still people going out and purchasing homes and holding on to homes and stockpiling land and all this other stuff because there is no benefit to selling, right? If you go out and you sell some of the stuff, if it's a secondary home, if it's an investment property, and you're not purchasing more real estate, then you're going to take a tax hit. If it is a home that has been a primary home or a secondary home that's not an investment, you go sell it, you're going to take a tax hit. People are continuously buying real estate. We know this creates more millionaires than anything else in the history of our society. And so, as we're looking at this thing, guys, this is what it's saying, right? It says, despite the difficult landscape for first-time homebuyers in recent years, it says real estate is the best option. Peaked at 45%, right? Here we are in 2022. In the most recent poll, real estate still cleared the top by a considerable margin, with stock markets and mutual funds winning 22% of Americans' favor as the second most. Okay, so here we are, right? Here's your stock. Like it did fall off a little bit. Gold started popping up because people were getting worried, right? Oh, there's an election. Who's going to win? Like what could happen? And so people start buying gold because, that's a world currency. Now stock markets are starting to come back up. And we've been seeing this kind of ebb and flow, right? And like we hear on the news that all this bad stuff's happening with our stock market, and then the next week it rallies. And so like these are just the different things that we need to keep in mind as we are having conversations. Like, people are still buying real estate. Real estate is still the number one asset that most people think of when they're thinking about securing long-term wealth. Because here's the thing. We talk about it being a hedge against inflation. Think about where rates are right now, right? We're talking about the average consumer is locking in somewhere around a 7% without being able to, do buy downs or insert whatever here, depending on what their credit looks like. And so when we talk about this 7%, think about the people that bought 4 or 5 years ago and they're in at 3%. It's not fluctuating. They're locked in. So it doesn't matter what happens in the economy, they're locked in at that percentage. What do we also know? Since the 1990s, real estate has historically appreciated 4% year over year. Yes, Colorado, we've slowed down a little bit. We're somewhere around like 2%. And yet, when we think about this, we say that our money's locked in. We're not seeing fluctuating rates. We're one of the only countries in the world that has a fixed rate mortgage. We are the only country in the world that has a 30-year fixed rate mortgage. And so when we're looking at this, our money's not fluctuating up and down. Homes are appreciating. And this is where most people go. And this is why we see people from China purchasing real estate, Canada purchasing real estate, Russia purchasing real estate in the United States, because we have a great loan product and real estate, historically speaking, goes up year after year after year. And so here it is, and they're doing it by ages, right? So now they're going through 21 through 43 and they're going 44 plus. Like, so your top line, your green line is your 21-year-olds to 43-year-olds. So let's call them what, millennials and Gen Z. I don't know what's before millennial or after millennial. I have no clue. And then we are looking at late millennials and whatever comes before the boomer generation. I have no clue what that is either. So sorry, I have no help there, but you can Google it and you can figure out who these people are. And so when we look at this thing, they say real estate. Well, number one, right? They're saying real estate is the number one investment that 21-year-olds to 43-year-olds are thinking about. So cool. So we know this generation probably has a little bit less money than the older generations, which we do know. There's no thought behind this. We know this. And so then when we do this, we couple this with the last thing we just looked at for new builds, knowing that brand new home, better interest rates, and how can we do a marketing campaign to them? Well, we know they're on TikTok, they're on Instagram, they're on Facebook. Guys, like that is your target demographic. We know that the target demographic living on social media right now believes that real estate is the greatest investment that they can possibly own, that they might think is outside their affordability. What are we doing to get the message out? And then we look at the 44 plus. Well, they're looking at equities. All right, cool. So they're looking at equities and that's their number one, but close second is real estate investments as well. So here it is, right? Tangible assets. I guess this is like Pokemon cards. No, I don't know. I don't know if it's Pokemon cards. But maybe gold, maybe something else. Who knows? Direct investments, private equity, international equities, emerging markets, domestic equity, crypto, digital assets. We can obviously say this is no longer your I can't, now I'm drawing a blank, but your digital art anymore. Like that's now gone. But maybe crypto, right, is what we're looking at here. So I say that to say this. We have a great opportunity when we're looking at where most people see real estate as a great avenue to create wealth, the American dream. And what are we doing? Because I was at my DMAR meeting last week, right? And so I'm in DMAR and I'm sitting down with the directors. And one of the conversation comes up that one of the lenders, it's a pretty big lender in Colorado, was having a conversation with us. And their point of view through the conversations they're having is they're having a lot of conversations where people are actually figuring out what they qualify for. There's a lot of people. In their opinion, in Colorado, there's a lot of people that are going and figuring out what they qualify for. Yet the other conversation is that they're saying that maybe they're looking for their forever home. which is interesting because like I don't believe that I'm in my forever home. I don't know about you guys, but when we're talking about these first time home buyers now that they're looking at the cost of money being what it is, and they're thinking that there's an affordability issue that they're running into, where can we find opportunities for them to get them into a home to where it could turn into an investment property down the road? And then being able to be that real estate economist of choice. Like these are the things that we need to be thinking about. These are the modern day problems that we're running into, that when we're talking about what am I worth and why compensation is not going down, these are how we provide value to take massive mind share, to be that real estate economist of choice, to be someone's future real estate for the next 40 years. First time home, great incentives, great rental property down the road. I'm your person. How do we take that mind share? And coincidentally, they actually had another one. So we're growing two back-to-back articles from these guys just because it's just infographics, and who doesn't like a good infographic? It says America's homes and the people who are buying them are getting older. A shortage of new construction. And we looked at this, 1/3 of the inventory that we had back in 2008 is active inventory for new construction right now. And so it says US first home buyers, right? So this is first time home buyers. This is funny, like the way that it reads is down here. The average age for a first time home buyer in 2024 was 38 years old. All right, so let's take our 38 years old. It's fitting right here. These are the people that still believe real estate is a great investment. And we know that when we get closer to the end of this spectrum, these are the people that are more established. They've probably been in their job, they've up leveled a little bit, they've had some savings, like things are going a little bit more in their favor, probably versus a 21-year-old. Your repeat buyers in 2024 were 61 years of age. Well, this is the thing. Like we obviously know that 61-year-olds are also on Facebook. They get on Facebook to look at the grandkids and to, kind of see what family's doing. And yet, this is what I would say. Like, how are we getting in front of these people? Like, what are the communities that you are a part of, that where there's a population where you can have a conversation around real estate to be that real estate economist of choice? It doesn't matter what it is, guys. And while we don't go to church to, have real estate conversations, like, are you there? Are you getting invited to people's kids' birthdays and to where you get to get in front of their family members and have a conversation there? Are you a part of a bowling community, a wine club, an insert, whatever here? Like, this is what this is telling me. 38-year-olds to 61 is my demographic that I need to be in front of, because these are the people buying houses. And so take an evaluation, think about what your world looks like and what your business is supposed to look like. And does your marketing campaign and your GPS, right? Does your goals, your priorities, and your strategies to hit your goals line up with a demographic from 38 to 61 years old? And if not, what do we need to reevaluate, right? What do we need to do to get in front of these people? Because this is the graph. This is the graph that's coming through. I think this was Redfin. Yep, it is a Redfin graph. And so Redfin's doing these surveys. They're a huge third-party aggregator of information, and this is what they're finding out. So how do we get in front of these people, right? 38 to 61. Money, the cost of money is going up. We have an affordability issue in the United States right now. We know that a later age millennial in the 38 plus has the ability to purchase a home up to a 61-year-old, where we think about this. I don't think that's a boomer generation. I think that's younger. But yet, when we start thinking about wealth and where the wealth is, this is the demographic that we need to be getting in front of. What are we doing? And then, right, the other part of this graph or this article is saying that the homes are getting older too. So the median age of a home that is sold in the United States right now is 36 years old, which is kind of interesting to think about, right? Like we're looking at this thing, this is going from 2012 to 2024, right? Which is not a huge time period, and it's not even a huge jump, right? We're looking at this thing, the average or the median home back in 2012 was 27 years of age, and now the median home in 2024 was 36. Again, rear view facing data, because that's the only data that makes sense in our world. And again, median means that we're taking out the outliers. So we're taking the brand new builds and the old Victorian homes and the 1800s farmhouses, and we're just backing into that middle number. So in 2024, most people are buying homes that are 36 years of age or older. Now, I know that goes against what we were just talking about when we were saying, like, let's go find new builds. But I would say that the reason why the new builds are not being capitalized on at this point is because your people don't know about them. They don't know about the great incentives. They see the red balloon up in the air, but maybe they don't want to go in. So how are we getting that information out, right? Like, what are we doing to go through and to figure out what incentives are out there? How do we solve the problem of the affordability issue that we're running out here in Colorado with higher interest rates, higher prices than the rest of the nation? Plus, here are all the upgrades. Are you interested in purchasing a house? These are the modern day problems that we need to have the solutions for to live big lives as real estate economists of choice. But let's go through and let's do what we always do. And let's talk about Logan Motoshami from Housing Wire, and better mortgage spreads boost housing demand in 2025. Says one of the lesser known storylines in housing economics is the improvement in mortgage spreads. Well, we're not going to talk about mortgage spreads, but we are going to talk about purchase application data. And when we're talking about purchase application data, this was actually the message that was delivered down to the KW leadership team that went down to Austin last week. I don't know if you guys heard, but Margaret was on a panel. And so they actually had Logan and the team down there, and this was like one of the big headlines. So this is when we're going through, we're not going to talk about spreads, we're not going to talk about treasuries, but let's talk about purchase application. Guys, check this out. This is what's exciting. Your purchase mortgage application data has gone up. Here's the thing. Yes, we do have an affordability issue in the United States. You absolutely have an affordability opportunity here in Colorado with our price point being where it is. The mortgage rates don't change, but our price point is a lot higher than most of the nation. And so when we're looking at this thing, though, look, we had a spike. We had a spike in your consumers raising their hands saying that I am interested in what I qualify for. And I just told you last week, I'm in a board of directors meeting for DMAR. And we had a very, very big lender in Colorado talking about to us about what they are seeing and the amount of people that are actually coming through to figure out what they qualify for right now. Are these your people? Do you know who is in your ecosystem right now that has reached out to a lender and has not brought you in the loop yet? We need to be going out taking massive mind share. Is it on social media? Is it text messages? Is it phone calls? Is it going to family gatherings of other people's families? What are we doing to be that real estate economist of choice, guys? Because as I'm looking at this, we can talk doom and gloom all day about interest rates, and we're going to look at interest rates as we always do. And yet, when I'm looking at this information, interest rates aren't moving, but more hands are going up. Guys, look at this. I mean, this is 2024. 2024, 2025, we have more people in 2025. And not only do we have more people in 2025, we've seen an increase week over week over week, right? Where it's gone up. More and more people have raised their hands to talk to lenders to figure out what they qualify for. And I'm imploring all of you, please, 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 for you and your family's sake, make sure you're talking to as many people as possible. Make sure that one of these hands that went up is not someone that's in your ecosystem that you have no clue that they went to a lender and didn't talk to you first. And so start taking massive mind share, guys. If we look at pending sales, here we are, right? We're not to 2022 levels yet, but we will be. We will cross over 2022 only because we're starting to get to that point where interest rates skyrocketed so quickly and that the sales started going down because no one knew what was happening. It was a really weird time. And yet we're over 23, we're over 24. We're going to cross this line here. We're going to cross it before the summer ends, right? Like we're going to get across this line very, very quickly. So your pending home sales, right? They have gone up and up and up. So there's more homes under contract right now. Your weekly inventory. This is also one of the headlines down in Austin last week. When we look at this thing, 33% more inventory last week than it was this time last week, last year. All right. That's how we're looking at all this. This is historical data versus weeks over weeks data. There's 33% more inventory. This is also why we're seeing price cuts, right? We're seeing price cuts, and it's because there's more competition for resale homes on the market. And so this is all obviously and always going to be the conversation of what is the motivating factor of your sellers for why they called you and put up their home to put up their hand to sell their house, and to figure out what we can do to strategically place their home in a place to where more eyes are on them so they can win. So we have 33% more inventory. We're sitting at 767,000 homes on the market nationwide. And the only reason why these homes are sitting for as long as they are is because interest rates. And we're seeing a lot of conversations happen right now where there's a lot of people imploring a lot of people to start lowering rates. And the issue to why the rates are not being lowered right now, at least from the Fed's perspective, and why the Fed has dug their feet into the ground, is they say, we don't know the implications long term or even short term of what these tariffs are going to do. And they're saying until we can actually get more concrete data, we're not lowering rates. We're going to keep the rates pretty steady until we start to see some more data points come through. And guys, but we know, for those who've been in the business, what we understand is that when interest rates start going down, we are going to see more and more people start raising their hand. And that's also why it's a good idea for our people to go figure out what they qualify for now. Get an idea. If you understand that you have a job that has job security, you have a salary that you feel pretty solid is going to be your salary over the next 6 to 12 months, you should be getting into the arena and figuring out what you qualify for. If you're thinking about that now might be a good time, but you're waiting for interest rates, you still want to start the paperwork and get a feel for what you qualify for. Then we can start moving forward from there. So your new family listings, we can see that we've kind of gone down a little bit. Price cuts, 37%. Guys, I still think we're still in line, right? When we start looking at nationwide price cuts, we know historically speaking, we see 1/3 of all homes in the United States take a price cut every year. We're sitting at 37%. I don't think there's anything to write home about. With more inventory, more competition, how do you make your home look better than the neighbors when you're looking to be the person or be the home that gets picked up? Well, if it's apples for apples, you got to be cheaper. So this is what we're seeing. This is not a thing of concern for me. This is actually good, right? As we're going through and we're looking at this thing, we're seeing home prices come down a little bit, as well as we're going through and we're seeing more inventory hitting the market. This is the perfect storm of things that are going to happen once we start seeing interest rates go down. These prices don't stay down for long either. So that's why we want to make sure our people are in the queue, that they're getting prepared. Because if they're thinking that it might be getting close to time to purchase a home, they need to start getting their financials in order and have that conversation with the lender so that when rates finally do come down, they're first in line and they can make the move. So this week ahead, which is the week that we're in, it says we will see how the market handles the debt downgrade, which has been a conversation. We're not going to jump into that, but there's been a lot of conversations and a lot of articles right now from Sunday and yesterday. And it says we have a lot of Fed presidents talking this week. They're going to see what happens when they have their conversations, right? Because when these people have these giant podiums, which they have, and they start making the comments that they make, they swing the market one way or the other. It says we also have both existing and new home sales data coming out. And so one of the things that we are going to be looking at, obviously more and more and more, is this jobless claims. We have a job loss Fed. The Fed, when we're going through and we see the tariffs and the implications that the tariffs have, what it's going to be the bigger play is when people start getting laid off from work, right? It's not like this thing's going to get too expensive. They're going to see if the economy starts to slow down, right? We have a recession where people aren't building new businesses. They're not hiring employees. They're having to fire employees. Their sales are going down. Like, This is what they're looking for. And here's the thing. I know we've had this conversation, but I think it's important that we do it again. We do not want a recession, right? Rooting for a recession is super anti-American. We do not want to see people lose their jobs. But guys, I'll tell you this very honestly and very candidly, a recession is actually good for every one of you on this call. And like, I don't want that to end up like in, anyone just rooting for this thing, but this is the deal. We go into a recession, interest rates start going down. The people that get hurt are really the shakier jobs. But yet the people that are qualified to be in their job that actually have a steady job that's not going anywhere, like those are the people that are going to start raising their hands to purchase real estate, right? Interest rates start going down, prices start going down. They're in a position to go buy. And again, like we're not going to root for that, but I just want you guys to all be very well aware, like with recessionary talks and everything, like you guys are in a position to where like your profession actually does a lot better during a recession. Now, where it gets weird is where we're kind of where we are right now, where like the cost of goods goes up and like the people are not spending money on real estate. That's where we're in a weird place. So we'll keep monitoring this and see where this goes. But let's talk about interest rates. Here's 1 month's worth of time, guys, and this is what's good. It's flat. This is why I think purchase application data is going up. We don't have this roller coaster of what rates are going to look like tomorrow, a month from now, 2 months from now. Like it's looking pretty flat. And while there's a little bump here and there, this is what your people need to have comfort in making decisions that are going to impact them 3 months down the road, right? Because here's the thing. If I list my house today, homes are sitting on the market a little bit longer. And so by the time my home gets a contract, that's when I can start looking for a home. And that's when I lock in my rate. So if rates are going up and down, that's what stops sellers from putting their homes on the market. This is what gives them comfort. So if we look at this right now, we can see that your 30-year conforming loan is a 3.8 and your FHA is at a 6.5. While both of those are up, I don't know why they're in green, they should be in red. But as we're looking at this thing, they're up slightly. This is what gives people comfort. And so when they stay as flat as they are, and let's look at like even just 3 months, right? Like this is a little jagged, right? Like this probably scared some people. But yeah, we've been pretty flat as we've been moving forward, and this is a good sign for things to come. But let's talk about Altos data. Let's talk about HLL2 as we do, because that's where the brokerage is. So your median price, 744, pretty much staying flat. If you look at your days on market, it's going down, which is interesting. So our average days on market is 62. So 62 days tells me we didn't price the home right. And so we're sitting on the market for about 2 months. And these are the conversations we need to be having when we're having these conversations with people that are thinking about listing their home. Your median days on market is 35. We're removing all the outliers. These are the people that are actually having the right conversations with their clients about pricing their home to get it sold. Because this number, this 44%, I think the 62 and this 44 correlate with one another. If you do not put your home on the market strategically priced, not only is it going to sit for almost a month longer, you're also probably going to have to take a price cut because more homes are going to hit the market because we have more inventory than we've ever had in the last 4 to 5 years. So with more inventory, more competition, you're probably going to have to take a price cut because the next home that hits the market is probably going to strategically price their home under yours, Mr. and Mrs. Seller. 0% price increase, which has been the story that we've been having for months. Guys, these are homes that have been sitting on the market, or I'm sorry, not sitting on the market. These are the homes that are new builds, and they're not going to phase 2, phase 3, phase 4, right? We just looked at the article on the very first article that we talked about these builders are talking about price decreases and incentives. They're not raising the prices of their phase 2, phase 3, phase 4. They're not bringing them to market quicker. They're slowing down production to keep the prices as elevated as they possibly can. So we'll continue to watch this. This number doesn't truly excite me. This is just saying that we're not seeing as many new builds hit the market. Relisted homes, 6%. We saw a little bit of an uptick here to where homes have fallen out of contract. And again, because we're not seeing buyers and sellers come together. Your inventory scores of 32, your market action scores of 42. We're saying that, hey, it's not as great of a seller's market as it was last week, but we're still in a seller's market. But yet we're seeing more the buyer and the sellers being able to come to the table together and agree to stuff, except for the 6% that's fallen out.